Tell me what you think this is. Think hard. What is it? Come on. Do you remember 40 years ago when Peter Venkman said this?
You're never gonna regret this, Ray.
My parents left me that house. I was born there.
You're not gonna lose the house. Everybody has 3 mortgages nowadays.
Hopefully you only have one mortgage, and I wouldn't wish a third mortgage on anyone, ever. Heard of the term HELOC and curious if there's a SHELOC? Then you stopped at the right place. There's no such thing as a SHELOC, by the way, but there is a home equity loan, which is the other side of the coin. And I'm going to stop it right there. Let's not give these people any more ideas. I'm here to help you review the difference between home equity lines of credit and home equity loans. Home equity lines of credit, aka HELOCs, and home equity loans are both forms of financing that allows homeowners to access equity in their homes, but they have key differences in terms of the structure and how the funds are accessed. The market for these products today is limited prior to what it was like prior to the pandemic, but you can still access these instruments from banks, credit unions, and mortgage companies alike. First, let's define a home equity loan. In essence, a home equity loan is a lump sum loan that you receive in one installment. After closing, the entire amount of the loan is advanced and you immediately start repayment. The rate, it's usually fixed for the term of the loan, meaning it remains constant. Longer the term, higher the rate, just like all other loans. Repayment is typically done in equal monthly installments over a fixed period. They can be as little as 5 years with maybe a max of 30. The purpose of home equity loans are often for specific one-time expenses such as renovations, debt consolidation, or major purchases. These work well for pre-planned expenses that you want to amortize over a period of time. Got it? Now here are the fundamentals for a home equity line of credit. A HELOC is a revolving line of credit similar to a credit card where you can borrow against the max limit as often as you want and as needed. Interest rates for a HELOC are usually variable, meaning that they can fluctuate based on market conditions. Most typically, HELOCs are tied to the prime rate, plus or minus a margin, and I would say on average is about 1%. Borrowers can access funds from a line of credit during the specified draw period, which is typically good for 10 years. After the draw period, the repayment period begins. If the lien isn't due in full, it can probably be converted and amortized into a loan. During the draw period, you may be only required to make interest-only payments. Payments are going to be based on the balance, and in the repayment period, you repay both the principal and interest, and the outstanding balance decreases as you make principal contributions. HELOCs are often used for ongoing variable expenses, such as home improvements or over time educational expenses. Here's what's similar between a home equity loan and home equity line of credit. First, both types of loans use the borrower's home as collateral. In many cases, the interest paid on both types of loans may be tax deductible, but local tax laws can vary, so it's essential to check the current regulations. Both usually subordinate first lien mortgages. And likely in this market, you've secured a below market rate on your first, but you need an equity payout, so this essentially breaks up the total financing. Both are great short-term vehicles of finance. HELOC may not be your best option due to the variable rate if you're looking to finance this expense long-term. They also share low acquisition cost of capital for immediate expenses. Both usually rely on your income and collateral as value. Terms offered may depend on your credit score, your income level, the home value via appraisal, or may be capped or limited in some way based on your balance of equity. Both work very much like a traditional mortgage. There's an application process followed by a review of your credit, your income, and the property value. After all that's assembled, underwriting begins and your lender will then verify title in order to secure the loan. After the rescission period, you can access or receive funds. Last, since this is leveraged against your home, you will need to pay it as agreed. Sometimes you can access or sign up for a line of credit while securing your first mortgage, say if you were buying the property from inception. Other times it's just done after closing and separately. When purchasing a home, it's called a purchase money second. And this is a critical difference later on down the road if you do look to combine both. It's a difference between a good rate or a fair rate in the bank or the lender calling it a rate and term refinance versus a cash out refinance where the rates are higher. Now, here are the differences. The structure is different. Home equity loans provide lump sum upfront, while HELOCs offer flexibility with a revolving instrument. Home equity loans typically have a fixed interest rate, whereas HELOCs often have variable rates. Home equity loans have a fixed payment schedule, whereas HELOCs have a draw period followed by a repayment period and some more flexibility accessing your funds. HELOCs are open-ended, usually good for 10 years, while loans have a fixed term, remember 5 to 30. At the end of the 10-year draw period on a HELOC, it would be necessary to refinance that balance or pay it off. Now on a loan, you're just going to finish the term. And watch out, some lines have a demand feature. You're going to want to check with your institution. But HELOCs can also have P&I payments, but traditionally they're interest only. Loans usually have a flat principal and interest payment. So which is right for you? When deciding between a home equity loan and a home equity line of credit, it's critical to consider your financial goals, the purpose of the loan, and your preferences for repayment and interest rates. Additionally, it's advisable to consult with a financial advisor or accountant to determine the best option for your specific situation. Sometimes these are a great faculty to have for reserve or emergency purposes, say to fund that new roof. Better to have and not need than need and not have. Last, it's going to take some time for you and your lender to get on the same page, so try to start the process before it becomes too late, or if possible, when you're acquiring the property upon purchase. There you have it. See, you want it, now you got it, and you should be good from here. But I think I forgot something.
What?
Don't cross the streams.
Why?
It would be bad.